Derivatives trading involves substantial risk of loss and is not suitable for all investors. Past performance is not necessarily indicative of future results.
So stressful when the world's on fire. Good God. I can't look at this, guys. Like, my strategy is you buy it and you hope that you got a good spot. Yeah, but we all think you're crazy. You don't fight this. No way. The markets are freaking out and you don't think that anything is wrong? Come back tomorrow and I'll lose it all. Should be fun. Good morning, everybody. Well, welcome to the first day of the rest of our lives. Man, yesterday was so insane, and they didn't stop. Going into the close of the S&P 500 yesterday, it was like a $2 to $3 billion market on close buy. Totally insane. Good morning. You have a question? Ask your question while I go through the chart instruments here. So anyways, going here into S&P 500, like even into the close, they were buying crazy. So absolutely tremendous day in the S&P 500. And we got here in the treasuries, like huge jump, just absolutely bonkers stuff. Oil up, natural gas only up a little bit. That's good. Gold and silver really did well yesterday. I'm finding it. You know what? Gold and silver continue to amuse me because it was like everybody wanted to get in when we were seeing inflation, and I thought that gold was a good hedge against inflation, and it just completely failed in that respect. We were all dead wrong on that one. And now it's like gold is just taking off. And since we're getting some buying from some of the smaller, more periphery central banks kind of giving them support in gold, the Goldman Sachs is saying that gold is a good, it has a positive outlook is what we would say. So, yeah, that one's just so crazy. We got copper of course up, and Bitcoin was up, but it has given up some of their gains overnight. The drama in Bitcoin is not over yet either, by the way. Like, we're still like, is FTX gonna go under? We can talk about that a little bit later because I have some opinions on that. And the dollar getting crushed and going back to 106. I would love to see the dollar back at 100. That seems reasonable to me. Man, NASDAQ killer, I just gave you a whole 2 minutes. You didn't ask your question. What? Come on, brah. Okay. Oh, it looks like I did not turn on this. There we go. Also, in Stream Beats, we have... So, okay. No, we want enable shuffle. Okay, yeah, okay. Oh, it was just a really long question. Can I get a join big order that follows the price as it moves? Easy, right? I spent 75 freaking hours trying to figure this out with these incompetent software engineers. On what platform? If in NinjaTrader 8, we could totally do it. In fact, I think I already wrote one like that. You can totally do that. And NinjaTrader, sorry, doesn't Jigsaw have something like that built in? Let me see here. Strategy Manager. I don't know how you do it, but I'm pretty sure that Jigsaw had something to follow the order up. Do you think Bitcoin? Well, I don't think that the Bitcoin really has anything to do with what we saw yesterday. So I should get into this because I saw a lot of this on Discord. Well, first we had one person that ended up being in a position against the move and didn't have any kind of stop set. Please don't do that, guys. Do not hold positions going into the biggest moving events. That's unless you have a really big account and you probably want to have a stop. You can have your stop really, really far away, but okay. But second of all, I saw a lot of people that just didn't seem to understand the significance of this, right? So first of all, right now, the jobs numbers and the inflation numbers are like the most important data points to the market. And this particular inflation point is particularly important because of where it is placed in terms of what the Federal Reserve's plans and policy is, right? So the Federal Reserve wants to slow down the pace of interest rate hikes and then hold interest rates steady. So in order for them to do that, they need to see inflation slowing down, which is what we're seeing. So, right? That's why it's so important. And the options were already pricing in a lot of volatility. And then we had a really, really big beat on that number. So you got to realize this is a number that under normal circumstances is 0.3 and you get 0.2. Okay. So to have it be expecting 0.5 and getting 0.3 is a large move. It's a large deviation from expectations for that metric, right? When you extrapolate it out over a year, that's like 1.2%, right? So that totally matters, right? Anyways, and then you had all of these people that were like short the techs and the CTAs that were kind of had been short. So like that shift in direction and everything really moves a lot of orders. So I think that it was largely the move that we got in the S&P 500 was what I thought it was going to be. Actually, like go back and watch yesterday's stream. And I said at the very beginning, some analysts are saying that depending on what this number comes out to be, we could get a move of over 5%. And that's what we got. So totally crazy. I'm actually a little disappointed because my portfolio yesterday, I only got 4% because rare earth resources was down. So a little frustrated about that. Yeah, I'm pretty sure that Jigsaw has a chasing order. I don't know how to do it. I've never used it. But in Ninja Trader, all you'd have to do is say, for each data that comes in, make my order be equal to the current bid or current bid plus 1. So it's definitely a thing. Now, how they implement it and everything, that could be different, especially if you're using it as like an entry or exit sort of a thing. Because like, I think when you're doing that, what you're waiting for is like a spike of some sort that you would hope to come back, right? And then, like selectively enable and disable it. Anyways. So, and I there should be no doubt about it. I think that yesterday was the culmination of a number of significant changes in the world that creates a significantly different environment. So we really, really need to be aware of these changes, and we're going to have to be on the lookout for how we adjust accordingly, right? I believe, so we don't really know, but the thing that I'm going to be looking for is that we should probably see the move index come down now, right? Bond volatility should decrease after that, right? It's safe to buy. Now the natural consequence of that should be more liquidity in the market. Not seeing that this morning, but today is a holiday for the banks, so keep that in mind. Probably not going to see a whole lot of activity in the treasuries. Excuse me. We're probably not going to see a lot of activity in the treasuries until the 8 o'clock news. Okay. I mean, shelter and services, less energy have not come down at all, though. Okay, so one of the things that you have to consider with inflation is that you have to remember that the number that we are measuring is essentially acceleration, right? So what you're saying is, okay, but it's still 0.3, and that's still inflation, right? Well, I don't want to disappoint you, but you have to know. You have to know. I'm telling you right now, you're not going to see that number negative. It's not going to happen. You're not going to see that number negative. But what we will see, what we should see rather, is we should see those numbers come back to 0.3 month over month consistently. That's what is the Federal Reserve's target rate. Okay, because you want to see that 0.3 month over month consistently. Okay, but what we have seen is the pace of acceleration has slowed. So we are getting an inversion where it's coming back to the mean, and it actually kind of suggests that it's already back to the mean, and it may actually turn out. It may actually turn out that the Federal Reserve has to start shift their policy quicker than they expect, because the housing component in particular was still really high. Okay, the housing component was like 0.8 or something like that, right? Which was in line with shelter and services, less energy are not slowing down. Well, core CPI was lower, okay, but the shelter CPI in particular was still 0.8. That's true. Okay. But the important thing in that one is that the analysts like at Goldman Sachs and JP Morgan, et cetera, they are able to call what that number is going to be exactly. So they understand enough about that data series now. So I had a video about this, right, where I talked about the shelter inflation, right? And what were we seeing? Based on the forward running, or I shouldn't call it forward running, based on the private numbers that are more leading, we should start to see that shelter component come down. And by the way, they're saying that they're going to change that metric, but even if they change that metric, it's actually still a little bit lagged. I digress. Okay, but we're seeing those numbers match what we expect, and the trajectory based on the Redfin and all that numbers are that that component is going to come down, and it's going to come down very quickly as well. Okay, so even though that was 0.8, right, it being what they predicted was a big deal. Like if that number had come out and it had been 0.3, like say we still got 0.3, but the shelter inflation component was 0.9, then it would have been more mixed, right? It would have been more mixed. But basically the market is acknowledging that the shelter inflation is going to remain high because it's so lagged, and they understand that, and the Federal Reserve understands that, and they're accounting for it essentially. Okay, so I wouldn't do that. Anyways, I was trying to get into like what's changed, how do we need to adjust? Okay, well, from the perspective of the day trading, okay, we should expect volatility to come down. So the kind of trades that I've been taking this year and that I've been doing really, really well on, where I just catch some momentum and it just runs and runs and runs and runs, probably can't do that as much anymore. I'm probably going to need to focus more on, 10 ticks. If we get 10 ticks, I'm sorry, my stomach is kind of, my bowels have been all messed up this week. So I keep like pausing and hiccuping and stuff. Okay. We may need to focus a little bit more on market making strategy type things. Okay. Like we may get back to a point where worrying about where we are in the queue and how much risk we're taking on per trade and all that sort of stuff matters more, right? So that's kind of the shift for us. From the political sphere shifts considerably too. I don't want to speak too soon on the political front just because it is expected, based on all of the reports and rumors and so forth, that Donald Trump will in fact announce that he's running for president next Tuesday. I am not looking forward to it. They're trying to convince him to not do it until after the Georgia runoff because they're afraid that him announcing that he's running for president will hurt them in the Georgia runoff. Right? But it sounds like he plans on running. Meanwhile, you're seeing the Republicans shift. Like all of a sudden, the Republicans are like, oh, hey, yeah, actually candidate quality matters. And Donald Trump does really hurt the party. And Ron DeSantis, meanwhile, did really, really well. That's the narrative that you're seeing. So I think that there's going to be a shift there. But the Democrats probably shift more towards attacking Donald Trump, right? But the other interesting side of this is that I think that this really matters more for Republicans. Funny watching people come to terms with the fact that Trump is a Democrat tool in 2016 was a result of it unexpectedly malfunctioning. I think there is some truth to that. I mean, I don't think that Trump is a Democrat tool per se. I just think that Trump is an opportunistic ally, which is to say that in the current geopolitical and economic environment that we were in, that Donald Trump and conservatives' goals aligned, right? But it is true that in the long run, I'm not going to say that Donald Trump's not a true conservative or something, it's like the no true Scotsman argument, but there are some very significant differences between Donald Trump and the traditional conservative base, and Donald Trump's base is a little bit different and is maybe not wanted. Okay. I don't want to say not wanted, but they're not, they don't necessarily get along with the traditional conservatives, right? Favorite news so much. Well, thank you. Okay. I'm everything that I try and do here on the stream is only like, it is all comes back to trading in the end. Like we have to understand the political environment because the government has such a huge impact on the trading, right? Anyways, it's going to be weird, but like it looks to me like what's going to happen is Donald Trump is going to announce and Republicans are going to be like totally irate. And the thing is that's what happened in the first time. That's what happened the first time. And Donald Trump said, see, look, the establishment is trying to keep me down. And that helped him. Right. I don't think it's going to play out that way. I don't think it's going to play out that way because voters have seen the drama that he causes. And I don't think that they wanted this election. I think that they want something a little bit more stable. Right. They want to take the things that Donald Trump did bring in, because there was a lot of things, okay, that Donald Trump focused on that the conservative base likes that the politicians weren't doing. Okay. Like that's the truth of it. Mitt Romney was a globalist and he supported globalist policies, and he was not like he said things about trade and everything that sounded good, but in the end his true colors came out, right? especially when he attacked Donald Trump for all of the same policies that he was endorsing, right? The Republican Party wants to be a party of localism, right? They think that the government closest to the people governs best. I got to tell you guys, I really, really strongly believe that. I really hate when people want to put off their own responsibilities onto me. They're like, I'm like, okay, guys, like this has changed. And they're like, okay, so what trade should I take? No, like if you want me to do that, you're gonna have to pay me to be your financial advisor. I don't have the license for it yet. I'm getting there, right? But otherwise, you have to take a survey of what's going on and make your own decisions. And so all I can do is give you the information that I think is critical to making those decisions, and then you have to decide where you're going to go, right? Okay. But the Ron DeSantis, he understands those things, and so the Republicans think, at least right now, that with Ron DeSantis they'll get like this just right trifecta where he has enough of a engaging personality, competency, and is still against a lot of these globalist and or progressive nanny state policies that Republicans really hate right now, right? So I do think we're going to see the Republican Party turn more towards DeSantis, right? But the other thing for Republicans, and this is really important if you're a Republican, right, is that inflation was the issue that really drove people out for Republicans and really shifted moderates, okay? But there was a large portion of moderates, and especially like let's say the kind of leans Democrat kind of people that are still allured. Should I say allured? They're still being driven by this narrative that's been pushed that the Republicans are fascists, right? and Donald Trump being at the top of the ticket doesn't help that, right? But so they still have a problem, right? Because there's these people that, I mean, good grief, look at Pennsylvania. You get I heard somebody mention who in the world voted for Fetterman. The Democrats did. It's like, seriously, they'll vote for a guy even if he can't string together a sentence. They'll still vote for the guy. I mean, they voted for Joe Biden, right? They don't care who their candidate is, do they? But that kind of is a key lesson and point that Republicans can exploit, right? And you can't exploit that if the person that you're nominating is crazy, right? But if you take the perspective of, we need to be a serious party still, and we need to recruit people for office that are smart and know what they're doing, right? But you're not going to be able to just ride the wave of inflation is really bad anymore. You're not, because it's cooling off. So what are you going to do in 2024, right? You're going to have a different message probably, right? Republicans are probably going to need to shift more towards like the problems on the border and the budget and all of the other terrible things that Joe Biden has screwed up, right? There's plenty for them to work on, but they probably can't focus on just the inflation. And the warning that I would give to Republicans is, don't fall into the trap that the Democrats just did and become economic deniers, because I can already kind of see it happening where it's like, well, if the economy is not doing what I want, then it must all be fake and they don't believe it, right? Okay, you got to stick with the economic reality and listen to the economic experts that are favorable in our field, let's say. Okay. Anyways, but this now extends to like everything else, right? So like the bigger picture here is, this year sucked, right? And it's been popular to complain and to be the doomsayer. Inflation, I mean, I did it, right? Inflation is coming. Interest rates are going to get higher. They're probably going to continue to get higher, right? The risks are to the upside, etc., etc., etc. Okay. Now that we're past that, what do we do, right? Because think about it. Volatility probably going to decrease. Low of the year, probably. Man, I mean, it really makes me nervous making that kind of a call. But I really truly believe that we've seen the low of the year, certainly for the year, if not for several years, the low in treasuries. There are a lot of headwinds ahead of us still in equities, but I think that it's probably likely that we also have already printed the low in equities, but that's less likely than it is in the treasuries. That doesn't mean, though, that the S&P 500 goes up to the highs, right? It's going to be a difficult road ahead because the interest rates are still going to be high and they're probably going to be left there for quite some time. Okay. So you're not going to like go right up to all-time highs. It just means like it's okay to buy, and we'll get very, very gentle and slow uptrend instead of it's just down every day all the time. So how do you react to that? How do you shift to that? We have to move from complaining about everything to finding the opportunities, because there are more opportunities now, but they're not just going to be shoved in your face like they were after COVID, right? You're going to have to actively go out and find them, and you're going to have to actively go out and make them happen and build them, right? So really what needs to happen is we need to shift from a hunker down kind of a narrative into a building narrative is what we need to do. Now here on the channel, we kind of never left I mean, of course we were concerned about the economy, but like we never stopped trying to build the channel, right? But we may be coming up into a time period where the opportunities for us to grow the channel increase, and we need to be aware of it and take advantage of it. Which is why I think here, once we get done, I want to answer, keep this conversation going because you guys are making a lot of comments, but probably we need to look at our strategy document. So I think that that's the next biggest thing that we have to help grow our channel. Why it only chased it once? I don't know. The day before yesterday, repaired profile, then super squeeze was underestimated. So CPI reports tend to be some kind of magical market maker. I mean, I don't really think it's magical. Like, that's the thing, is that like that kind of frustrates me, is that a lot of people were like, oh, like the CPI number shouldn't be that big of a deal. Like, why? I can't believe that it's moving this much. I saw a lot of people shorting it and everything. And I'm just like, if you didn't know as soon as that number came out that it was a big deal, and you might be able to say, hey, it's not going to be a trend A, but it's going to move. It's going to move. And if you didn't know that, you're not paying attention to the right things. Right? Because I don't think you could get a more clear, signal, right, from the fundamentals. So if you weren't on top of that just means that you're not reading enough economic research, right? You're not keeping track of the narrative closely enough. So that's where you need to work. There was definitely denial. There's definitely denial. And I saw a lot of people shorting it. I actually saw a lot of people shorting it in the S&P 500 and getting away with it, which was just quite surprising. But you know what? I also saw a lot of people that were like me. So yesterday, I probably should have had a $200 day. Oh my gosh. I still don't know what happened, but it looks to me like I had platform issues. So first of all, you notice I switched back. I got rid of oil and the NASDAQ and put the S&P 500 up. I don't think that I have the stuff to be pulling that much data. In fact, I'm thinking next time we have a number that we think is going to be that big, maybe I should only just have up a DOM of the 10-year NZN. and that's it. Because, you know, like when I pulled up my performance meter, I was only at 60%, but that was after the problem had cleared, right? So it may have been that I was just pegged at 100%. So I guess that also means that I probably need to prioritize higher the getting a new computer. I was thinking about getting a new chair. I saw this chair the other day. It's like a $1,200. You know what was the chair that I wanted to get? It's like a Hamburg something chair. I want to show you this chair because it's so cool. Plus, I have a TikTok about office chairs that did really, really well. So, you know, it was this video that I found it from. Here we go. It's Haworth. Morning, Tobias. Is it Haworth Burn? You need to see the back of it. Yeah, this one. Yeah, the steel case chairs are good too. So this one is like $1,200, $1,500. But apparently, like, the back is like all flexible and stuff. But it's still it still lets the airflow through. Wow. Well, I'm glad to hear it, Slayer. Because I really feel like most retail traders are just kind of chasing noise, right? I've been working for a long time really hard on like what is the proper way to like present this information, right? Because it's like really technical stuff when you come down to it, right? And then I'm all talking about the fundamentals of the economy and you know, kind of shifts we're seeing in the markets that we might see and stuff, you know, like so like a lot of really deep stuff that I find a lot of retail traders just aren't interested in, you know. And how do you present it in a way that's engaging? And so it seems like I am getting better at it, and that those videos that I put out about that subject are picking up traction. At first I thought, oh, I totally bombed it. That didn't work. But I'm seeing those pick up, and I'm seeing people start to pick up on it. So I'm really hopeful. And I think that, you know, in the event that YouTube algorithm just magically decides to start sending tons of traffic over to the channel, that we have a really good library to educate people with. So really happy about that. Anyways, I want that chair. I thought, oh, we could save up $1,200 for a chair, because this one is kind of like, ugh, this one's not doing very well. But I think that I probably need to upgrade the PC first because of yesterday. Because I would have made like $200 yesterday. like that initial trade that I took. And the reality is that I might have been able to get even earlier than that, right? Would have been an easy $200, at least $100. But what happened was I clicked on a price over here, and then basically Jigsaw was frozen. So by the time Jigsaw actually processed the click, the price was different, and it processed the price at the new price instead of the price I clicked on. So I sent in a support request to them. I didn't lose money from it. But I was pretty mad. and then I didn't really feel like taking a whole lot of risk after that, because I know that once you miss like that initial first impulse, it's like a lot choppier and harder to make money, right? So I did that. What's my P&L this week or month? Oh, that's a good question. After last Wednesday, it's probably break even. Let's look. I built a dope computer. Well, when I built this machine, it was awesome, right? That's also why I am a little bit like, is it really the computer? You know? I don't know. I mean, I would doubt that it is, but can't really say for sure. Okay. Select that account. Oh, it's only showing this week. I'm like, that's not right. So let's go all the way back to October. Yeah. The month of October, we did really well, right? No. So we had made a bunch, and then on FOMC day, I gave up like 100, or not 100. I gave up $70, but I guess I'm still net up. So what I find is, at least right now, is that after all is said and done, I'm making about $50 a month, from just trading the micros, right? And then that pays for my commission or my data fees. So it's actually about what my goals have been. So maybe that's also part of why I haven't really been as aggressive as sometimes I feel like I should be. There are some of these moves where like this one right here, where I made like 50, it was like, that could have been triple that, and it happens. But it looks like I'm doing okay. And this is that day shouldn't have been as big of a loss as it was, but it's still within the margins for like the kind of a drawdown that I tend to get and everything. And I think if I come back here to show the stats, I should still have a pretty okay, 40%. We do need to get that up. See, I've been, as of late, I've really been doing well at like, oh man, because I had that one really bad loss, this came up. But beyond that though, I've been about 1.5 to 1 risk reward. So to get 40% is about in line with what we would expect, and so it's been pretty darn good, right? We would like to increase that percentage winning trade. But going forward, if the environment is going to change, these stats are probably going to have to change too. I'm probably going to have to move to an area where I'm getting more like equal risk reward and winning half the time or something like that. I can't believe how disciplined you are just putting in all this for $50. I guess it's better than simulation. Yeah. Well, and I'm not going to come out and risk, tens of thousands of dollars doing this, right? Like if I had already maxed out all of my tax advantaged retirement accounts, and then I still had thousands of dollars to blow, then maybe I would do that, right? So, and hey, maybe I think that eventually we will get there to that point. Like, here's the thing. You got to play the long game, right? You got to play the long game. I think that people expect to come in and trade for, I mean, at least that's what I expected. As I was like, how long does it take for you to figure this order flow thing out? How long, how long does it take to become like a good day trader? And I thought that it was going to be like 6 months. I was like, okay, it's been 6 months and I'm not really having success. What's wrong? Right? Oh man, so naive. I was so naive. And like for the first few years, I was, I was focused on many of the wrong things. I mean, like the content was always actually good, because one of the things that I always did here on this channel that I think has really been to my benefit is that I'm not going to say something unless I can like prove it, like there needs to be some sort of empirical backing to it. Like I can't come in and say, if you trade the way that Seth trades, or like I'm writing this strategy PDF, right? I can't come in and say, if you follow this strategy PDF, you are likely to make money. I can't say that, okay? Because it's very discretionary, right? But what I can say is that the principles behind the strategy are empirically backed, right? It's been almost 2 years and I still don't get it because I'm focused on the wrong things. Yeah. And that's why it's just like every day that you spend focused on technical analysis is a day that you could have spent understanding the economy and the news and strategizing for bigger things. And I mean, that's the thing, is that I am going to have to shift from, day trade market making to more asset management kind of a thing. Like after reading the Series 65 and going into all of that, like that's my big takeaway from that, is that in order for me to get to like the next level, let's say, because of course I can like take excessive risk and or just get lucky and or just be persistent enough and size up. But the reality is that day trading is kind of tedious and kind of a bum deal. I really enjoy doing it. I'm never going to stop doing it, but that's not going to be the thing that really gets you to like, where we often see ourselves going, right? And so I think to get there, it's going to have to be, I'm going to have to put a lot more effort into asset managing, like I used to think, okay, if the YouTube channel takes off, then I can just spend like all of my time day trading and making content or something like that. I don't think that's the case anymore. I think that if the channel takes off, that we still just stream until 9:30, until the London close, essentially. And then and we do spend a lot more time making content, maybe not a video every day, but maybe 2 or 3 videos a week, right? YouTube money is the real deal. Well, it isn't it? So, like, Graham Stephan, I think he makes like $6 million a year from YouTube now, right? But I'm kind of thinking bigger. I'm thinking like I'm in a position to be able to give people valuable information about managing their assets. And so I think that really what happens is we shift from, maybe we make 2 or 3 videos a week, but we also have an investment advisor business, basically. Right? And then once you're talking about that, now you're talking about real money, right? Oh, we'd still live stream for sure. There may be a day where we have to modify the live stream, right? For instance, the time might come where we have to limit the streams to subscribers only or something like that, because there's too many people. Like if like Matt, I see a lot of things from Matt these days that I'm kind of like, okay. But he has like 1,000 people a day watching him now, right? If I had 1,000 people every day watching, I would probably have to either modify how I trade or do things to limit the, you know, like, you know, there's different levels, and we would probably have to experiment around to see what worked best, right? Like one way you can do it is like limit comments only to subscribers, or have slow mode turned on, right? Or it's just live stream is only to paid subscribers or something like that, because you get to a point where there's too many people, it kind of hurts the trading, right? Are you transitioning from programming to banking? I don't know, Lucas. Like, here's the thing. Yeah, it's Series 65. So if you have a Series 65, then you can start, you can become an investment advisor representative. So I could come in and start my own investment advisor firm or join somebody else. I have a guy here. Well, not that I have a guy, but I have a target. There's somebody that's local that is apparently doing some investment advising that's heavily related to bonds, and I want to talk to this guy. I don't know how I'm gonna talk to this guy. I might just have to call them, but I think I'm gonna wait until after I pass the test first, because I don't want it. You know, I don't want it to be like, hey, I'm going to I want to work for you. I'm not necessarily looking for a job. And I also don't want it to be like, oh, hey, I'm going to compete with you, so show me how to do it. And that wouldn't work out very well. But I think that I'm hoping that this guy can mentor me. And there's no conflict with going on YouTube after getting a license? No, I don't think so. So there was actually a rule, specifically a rule. So I don't know who it was for, or what situation kind of brought this up, but basically they changed the rules. So like, if you want to give investment advice online, and that is to mean personalized investment advice to people online, you have to become a federal covered advisor. So okay, Sam Bankman-Fried resigns from FTX. No, I don't think it's not FINRA. It's it's with the SEC, I believe. Federal covered advisor registers with the SEC. I know it's weird, right? But that's the way it works. Because the laws that govern this are really from, you know, the acts that happened after the you know, in the Great Depression era, basically. Yeah. Yes, I'll be able to say, yes, I am a financial advisor. Yep. It'll be, yes, I am a financial advisor, but in order for me to advise you financially, you're going to have to give me a lot of personal information so that I can tailor the advice to your specific circumstances, and you have to pay me, right? But when I'm not doing that, I'm just giving general advice to the public, right? And you'll notice I don't come in and say, you should buy X thing, right? I kind of avoid giving that as general advice, but rather what I do is I kind of give you the piece of information that would suggest that you should or should not buy a certain thing, right? That's the way that I approach it. So that I'm only just giving you facts and information, right? Rather than a recommendation. But like, the thing is that it allows a lot of things, and I don't actually know what you do with it. All I know is that I've put enough work into it that I'm definitely going to get it. Right? I'm not going to put all that work in and then not take the test, because it was a lot. It's a lot of work. It's a lot of work. Right? But it could involve a career change. Like, I could go and work for GSAM. I don't know if having somebody that is both an experienced software engineer and an investment advisor is more valuable to someone, but maybe it will be. Maybe it will be. We'll see. You know, maybe it's like, well, it's somebody that actually understands these algorithms is useful to, you know, helping people select which one would be appropriate for them and stuff. I don't know. It's just another testament that not everyone has what it takes for day trading. Well, I don't think that it's like, oh, that we don't have what it takes for day trading, right? And we'll still have the live streams, and I'll still take day trades, because the thing is that being involved in the markets at this level, there's things that we learn that you just can't otherwise. It's kind of like, you know, if I was into horse racing, if our industry was horse racing instead of day trading, right? Would I really be a good horse breeder or trainer or whatever it was that I was trying to do in that industry if I didn't watch the races, right? Like you don't even necessarily have to put money on the line, but like you have to at least be like watching the races and trying to predict what's going to happen, right? There's just something that you learn from that. That's why I don't think that we're ever going to stop like day trading and having the morning live stream, right? It's just the acknowledgement that the next level, it's kind of like, well, okay, if I've met my goal for the year, right? Although it's really was my goal for the second half of the year, but so we'd probably have another year or two before we even get to the place that we're talking about. Okay, but you know, we're meeting our profit goals for the year and everything like that in trading the treasuries. Is just an acknowledgement that there is a limited upside with day trading, unless you're really going to take crazy risks, right? That's all it is, right? And so in order for us to continue growing, we got to move on to the next step. Doesn't mean you stop the trading, but it means that there's other things that we have to pick up from there, essentially, right? Instead of wasting my time back testing automated strategies on technical analysis that don't work, that time's going to be spent asset managing, right? I want to transition as well. I want day trading fund to my larger investments. Yeah. And the other thing is that I think I'm kind of obligated to do it. Like, there are a lot of people that are about to retire here that don't know how to manage their money, and they're not going to know how to manage their money. I know that that's like not what millennials want to tend to think. Like, millennials want to do it themselves, right? And I, you know, this is like when people want me to program something for them. It's like, well, you can program it. You should learn to program it. You should do it yourself. And here's why you should do it yourself, right? But these boomers, they're just not going to be able to do it themselves, and they're going to need help, right? And so there's going to be a spot in the market where, you know, we can help them without like adding on huge fees, you know, having to pay for somebody really expensive, you know, but just for like basic getting started advice and stuff like that. And then there's going to be all these millennials are going to inherit the money, and they don't know what to do with it either. You know, it's just like we have kind of underinvested in this kind of level of financial education because we assumed that like only rich people had to worry about that stuff. And we're soon coming to a place where everybody's going to have to worry about it. Right? So I feel like to some extent, I'm obligated to do it. What's the exam? So the examination is a series 65. This is the test that you have to take in order to be a investment advisor or investment advisor representative. Okay. And I had a lot of prior knowledge, for sure. But the stuff that you're doing in the test is kind of like, if you commit securities fraud, you know, the penalties are $10,000 and up to 5 years, right? Like that, those are the sorts of facts that you have to know to pass the test. So it's hard. It's hard. They don't teach this in schools. Yeah. But although like the level that we're talking about, it is something. S&P 500 not looking so hot here at the moment. Well, anything above 3,900 is probably just fine, but it is in a downtrend at the moment. Okay, anyways, do you use indicator at all? Some funds on CNBC combine fundamentals and look at the major indicators like longer MA and RSI. Okay, so as I had mentioned earlier, especially daily moving averages seem to have some effect on the market. Like there seems to be a number of strategies out there or something to that effect that are using those daily moving averages as filters. So I'm not going to take the cross of a moving average on a daily basis as a signal to go long or short or for continuation or reversal or anything like that. But I do watch them, and I am going to be cognizant of order flow at those locations. And generally speaking, the way that I'm going to utilize a technical level is kind of the opposite from what other people do, right? Because other people say, I want to enter into a trade at that location, etc., 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 right? Whereas me, I'm saying, well, okay, we're getting a buying impulse here, and it was one that I predicted, and I want to go long, but we've got this moving average up above us. So I know that there's going to be a lot of back and forth activity at those locations, and that makes it a really good spot for me to work an exit, right? Or if we're already to a point like that and I'm not in a position, then I'm going to say, oh yeah, I might not make much sense for me to take a position here because they're probably going to fight over this level for a bit, right? You go and go back and look at them. You're going to find, let's see if we can find an example. We come back here to daily ES. Okay. So for instance, there are retracements. So I'm not using Fibonacci levels, but like 10% decline from highs, 20% decline from highs. Well, look, here's a place where when we got back to the 10%, they rejected it. And actually there was some rejection here. So from a technical perspective, that's definitely, people are going to look at that as resistance. But like, here's another key level. Like it bounced off of it once and then it came back down to it. And then what did it do? It chopped around that level a ton. And then they came back and we chopped around that level a ton too. Some more. We've had this chop around this 50-day moving average. Like when you're getting these things starting to cross, you get like these little, how do I draw this? It's not, my little mouse cursor thing's not working. Oh, that's weird. Epic pen crashed. But you see these nodes where like you get a bunch of candles in a range, like a really volatile range, and they're all just sideways action, right? Like you get those it kind of creates those kinds of things, which is where I want to avoid, right? So that's one way that I use technical indicators, right? But another way that we can, oh man, did we? Okay, hold on. We need to kill something here. Ah, Epic Pen is now responding to us. There we go. I'm just gonna kill and restart Epic Ben. Okay. Do Trenton I haven't really tested trend lines though, because there's like a really popular indicator for NinjaTrader that is like an automatically drawn regression line, and somebody back tested it and said it was really bad. So I just never bothered with it beyond that. Okay, so anyways, when you look at my charts, like I do have some indicators, especially here on the S&P 500. So the S&P 500 is a little bit, if you're going to trade technical analysis and be a noise trader, basically, the S&P 500 is kind of the place to do it. So you can see here, I do have a moving average. It's a super smooth moving average, which is more responsive. Okay. I have average true range stop. Man, you're going to find it, price come up to that level and then turn back around so often. In fact, it's doing it right here, right now. I don't think that that's a trade that you would, if you just, I back tested that one single indicator and just that on its own doesn't work. But man, I'm constantly amazed at how close they held to that. It's just, that's the range. They're just saying this is what the range is right now. To exceed that, it kind of takes something a little bit more, right? But I also really like R squared, because R squared is a sign of autocorrelation, right? So R squared ends up being a really good filter to say, okay, we actually are seeing some autocorrelation in the market, so you're more likely to want to take trends, So do that. And then all of the rest of them are like spreads and cumulative delta, right? So what was the point of that? Technical indicators can be really useful if there's like a type of market condition that you're looking for and you find it difficult to tell when you're in that condition. Can you not hear the background music? Can we enjoy some background music? It's just really quiet and calm music today. No, you should be getting it. You should be getting it. It's just maybe it's been turned down too much. How about that? Anyways, so the what I think you're gonna find is the more experienced you get, the less you use technical indicators, because you don't find that you need them anymore. Is there any other exam that will allow you to gain investment knowledge better than this one? I don't know. I've never taken any of them. So I do know a couple of them. So first of all, there's like a general SIE exam that as I understand it is pretty similar to the Series 65. Okay. And then, if not smaller, and then there's like a Series 7. So a Series 7 you have to enact securities transactions for other people, essentially. So if you're going to be an agent for a broker dealer, then you need a Series 7. So Series 7 would maybe be next step. And then there's also a Series 3, which we would need to run a commodities trading advisor. So that's kind of like the next step. Nav's book, or are we talking about Navinder? Andre went short here. Definitely feels tilted to the downside, although think the downside is going to be limited. You can definitely see here the treasuries, like both in the liquidity and the amount of movement that we've had. They're just there. It is a bank holiday, so you're not getting all that institutional. But we do have key news at the top of the hour, so we will want to pay attention when we get to that. Certainly think people have a better chance if they invest instead forget day trading. You need to be in a very particular and special situation to want to day trade. Yeah. So the way that I think we should approach this is, what are your goals? So if your goal is capital appreciation, then day trading is probably not the way to do it. Okay. So if your goal is capital appreciate, why can't I speak today? What the hell? My mouth is too dry, I guess. Okay, so if your goal is to appreciate your capital as much as possible, then as a small investor, it is probably best for you to just focus on maxing out your tax advantaged accounts, right? And then maybe you can move to managing a small portfolio of like 5 stocks or something like that, right? And then if you have a larger amount of money, or you're willing to take on more risk, then I would look at things like getting involved in the real estate market, private equity, angel invest, these sorts of things, right? And that's where you can really like grow your money to amazing sums, right? Or if you're young and you have a lot of time, trying to go the institutional route is worth trying, right? Okay. So who should be day trading then, right? I think that the goal of day trading is, one, you're looking for consistent income. 2, you really, really want to be involved in the market, right? And primarily, you really, really want to be involved in the market, right? If you're gonna trade futures, that's really what retail trading futures is about. Is you love the markets, you really want to be involved. Just don't, and that's kind of the issue, is that most people come into the space thinking that futures trading is the best way to make mondo amounts of money. Well, I mean, you can make a ton of money. Futures trading is just like, there's a lot of risk involved in it, okay? Not very many people actually make that money. And it's an unrealistic expectation to come into futures trading and think you're going to become a millionaire. Should only do it if you really want to be that engaged in the market, right? I live and breathe finance. You can't talk to me without me bringing up the markets. It's just, it's all consuming. All I do is read news, That's me. If you don't want to be that person, then futures trading is probably not for you. You've blown 6 accounts? Wow. I think, well, I've never like blown an account where like the broker, where like, I owed more than what was in the account or something like that. But gotten to the point where I needed to refund myself. Yeah, I don't think it's quite 6. I think I'm more like 3 or 4 where I've done that, right? And I wouldn't count my switch. So this year I kind of decided at some point that I was going to switch from NinjaTrader. And I had like I was trading only a $500 account, and I traded that for a really long time. And then there kind of came to a point where it's like, I'm really sick of them. And instead of just winding it down, I decided to take a dumb trade. So like I said, okay, let's just YOLO it then. Didn't work out. No, Ninja. Well, I've been removed from a position before too. But that was like, oh, okay, now you can no longer trade the full ES contract. Now trade Now trade the micro or something like that, you know. I don't even remember what it was now. Get desperate and YOLO, yeah. Well, it wasn't even like get desperate. It was like, I don't want to keep this account running. I want to switch. This is a good excuse to do something stupid, and it didn't work out. Because I knew like I had already had the stuff saved up to move the account and all that stuff. So yeah, the problem with day traders in the US is they want to replace a career where they make $200K a year and their living expenses are already that high. Yeah. Yeah, I mean, and that's the other thing is that futures trading involves substantial risk of loss. So it's really not suitable for trading. It's really not suitable for you unless you're already in the position to take a lot of risk. And like the issue is if you want to do it quote unquote full time and you're not getting outside income, that significantly curtails your ability to take on significant risk, right? So exactly like the disclaimer in the beginning. Yeah, well, but it's true, right? There's substantial risk of loss in trading. But it's not just that. Like I don't think that people, the majority of people coming in and trying to trade futures, and they're trying to figure out, how am I going to do this, right? So hopefully you come across Seth's channel and you say, oh, markets are more statistically efficient than they are informationally efficient. So I should be able to find more opportunities from informational inefficiency, right? They don't do that. Instead, they go over to whoever's YouTube channel where they're trading price action trading signals, and they see, oh, this guy, he made $1,000 today and he made $500 yesterday and $3,000 the next day, right? Oh, they must really be doing well. I want to trade the way that they trade, right? Well, they don't understand that the way they're able to do that is by taking on a significant amount of risk. So much so that in the event that they do lose, which is going to be less common, but when they do lose, the losses tend to be pretty big. And so it's really common to see those people blow their account and kind of like memory hole it, you know? And even me, so I don't like to take that kind of risk on my live accounts, but I'll do it on sim accounts all the time, right? If you look at my sim performance, I look like an absolute god. Why? Because I take on a ton of risk and take tiny profits, right? I think that's a really important thing to understand. And so if you really want to be able to make, you know, do something significant with futures trading, you have to be willing to take on significant amount of risks. Like you have to be willing to come in here on days like yesterday and be like, oh, I know this move is crazy and I'll have to hold a stop of like 100 ticks, but I want to be short yields, you know? That's what you have to do, because you have to take on significant amounts of risk. Did I finish the Spotify list? Well, I'll put on chill step. A little bit more energy. It was quite clear that this move from yesterday was not sustainable. Yeah. I mean, I think it is possible to have an update. But it would have to be a small update, right? But I think that probably a lot of what happened yesterday was like short covering, right? So wait, so I had asked the question earlier, and I don't know if you had answered it, because Lucas was saying Nav's bit book. So are you talking about Navinder, the flash crash trader? And if so, what is the name of his book? Because I was not aware that he wrote a book. But anyways. So if the whole thing is you have to take on significant risk, then the reality is that like trying to move from like a regular job into, you know, full-time trading futures, it's not like it can't happen. It's just it's probably not a realistic or proper goal for most people, right? And that's why I tell them, like, look, you can come in here and trade before you go to work. Okay. For those of you that they're able to do that, you can do that. Right. And or you can do your regular job and just watch the markets there sometimes, right? Whoever, now I wasn't talking about Vinny. Don't attract them. You start mentioning names and then people say stuff and then they come in and want, you know, I would prefer to forget that they exist. But there are a lot of YouTube channels that are based up primarily on price action. That's not Vinny. Vinny's not price action, right? But the bigger creators in this space, they're trading price action. And I'm just telling you, there's not really any edge to price action. They're just taking on a lot of risk. So that's what I meant by all that. What a buyback when anyways. So I'm interested here on, you know, I'm just kind of looking through Twitter, this whole thing about Sam leaving FTX, because like the whole thing is they need to bail out FTX, or like who knows what happens to the cryptocurrency world. And I'm kind of sitting here like, why bail them out? You don't want to bail them out. You don't want to enable that behavior. Well, Sam quitting, Sam resigning helps a lot, doesn't it? Sam resigning helps a lot. The rally, I do, right? I'm bullish gold right now, because it's not just like with interest rates not going crazy and rising all the time. You know, that was the thing really holding gold back. And then on top of that, there is like some buying from central banks around the world, like a lot of buying, not from like the big Western countries, but smaller central banks are buying. So like it looks like there's a good opportunity for gold and silver right now. Paradoxically, it's just seems like not what would happen, but what are your opinion? So I don't know a whole lot about SMB Capital, to be honest with you. I wouldn't assume that, you know, at any one given prop firm that all of their traders are profitable. They have some profitable traders, right? What I think you're going to find, so what I've seen from the guys at Axia, and I've both from watching their channel because they're pretty transparent, but also, you know, I have some people that tell me things that they've learned from talking to those guys. What you're going to see mostly is you do market making, right? You do some market making, and you take on risk in certain narrow situations, and that will generally make you money. But then what really makes it worth it is the big days where the market really moves, and then they're able to size up, and they're really experienced at managing multiple orders. And so they play that game, right? So I think it's a little bit of both. Like the thing is, though, you just have to realize that like book only trading, you have to be fast, right? So when you see people doing this kind of book only trading, market making sort of a thing, probably the way they're getting away with it is taking on risk, right? And that applies to me too. When you see me come in here on ZN and I put 5 contracts on, what I'm doing is I'm taking on significant risk in an area where I'm saying I believe that it's going to rotate around this area, and so it's okay for me to build up a position and take some profits off on it to give myself that extra risk. And then once I've made that ton of money, right, then I can take a more price risk for free, essentially, right? Now I can say, oh, okay, it can actually come quite far against me. I might even be able to add a contract, and then I'm back to like my original risk, and right? That's the game that you're playing. But if I was just to be like one contract, all in, all out, book only, probably not going to be competitive. Probably not going to be competitive against the robots to make consistent profit with that. Right? And while some of these guys do make big trades and they do make money, they also take big losses too. So you just, you know, you have to consider where are the gains actually coming from? What is the actual nature of the strategy? Is that actually appropriate for me? Right? And what I'm trying to show you is tiny accounts, right? How do I go about it? Right? Because if I can come in and I can do it with one lot, right? If I can make it out with one lot and a favorable risk reward kind of a thing, then I think that gives you a lot more confidence that the things that we're talking about are actually a thing, right? And so that's part of why I pride myself on the way that I trade right now, right? And that's something that's more appropriate for all traders, right? More edge and more appropriate. Because if your edge is only taking on risk, then it's not really helpful to other people. Because anybody can go and start a combine account and just take on a lot of risk, right? These other courses too, why would they do that if they are making all this money? I never understood. Oh, what, you mean Axia? Well, I think that they did that because of the way that their previous firm went, right? So in case you're not aware of the history, there was a prop firm called Futex. There was a prop firm called Futex, and they had a couple of traders that were really, really good, right? And were making money. Like Brannigan. Brannigan made a ton of cash from a couple of big trades that he had made. And eventually they went in to cash in and take some of their money out of the firm. And they didn't have it. And what had happened is the managers were, they're taking some losses, and the managers were taking the cash from other people and playing around and lying about it. So they went kaput. And so those guys that were successful went, broke off and started Axia. And when they started Axia, I think that there was kind of an acknowledgement that because of the nature of the risk that we're taking on, and the need to continually, bring in new people, that we had to have like some degree of support program for it too. So you sell the education. So that doesn't mean that the money is really being made from the education, right? It's just that it's an acknowledgement that the prop firm space is crazy hard now. It's just not what it was in the 90s because of the robots. So you have to supplement it in order to be able to really take on the risk, right? I think I heard the story you're talking about, Kyle. And that one I'm like, okay, so you did something stupid and got away with it. Good. all of them robots. I'm just like, the whole thing is okay. So here's, when you're talking about market making, book based strategies, a very large degree of the edge is being at the front of the queue. So if you can't get into the first half of the queue, the strategy becomes more break even. Okay, so it's like the strategy itself is break even. Then you add risk on top of that, you can make some money. But now you have fat tails to deal with. So now you have to have a lot of edge in being able to manage the risk and know when the fat tail is, and just, you know, avoid that day, right? Which is hard because you don't get a whole lot of practice over it, right? It's like it comes around like once a month or something like that, okay? Or you're supplementing it with your larger edge of the market, okay? But the way that prop firms when prop firms are like really popular, like in the 90s, the way that they were making a lot of their money was in being the liquidity providers, doing the thing that the robots do right now. And almost like Axia and SMB are like the only ones left. I mean, there's like the funded trader programs too. Some people call those prop shops, but that's like different because their business just wouldn't work without so many people failing the combine, right? Stop caring about other people. I'm just stating the plain and obvious truth, which is that there are strategies that worked in the 90s that aren't really going to be very effective for you today. Right? Like that's the whole thing that I'm trying to relate over to you is that there used to be a lot of ways that you could make money in the market without having to know a whole lot, right? Of course, the top players were the ones that always knew a whole lot, but there was a lot of people that they were just clicking and they had just kind of stumbled, or they were introduced to it by somebody else, and you know, we don't have that luxury anymore. In our market, you really do have to know something. You can't just go and find a technical strategy off of Reddit and turn around and use it anymore. It just doesn't work that way now. You're either going to have to find, like, if it's going to be a technical strategy, you're going to have to find something that's really complicated that other people haven't found. You're going to have to take on a lot of risk, or you're going to have to just have a tremendous amount of edge on the informational side, right? But understand, and the picture that I'm trying to paint here is like, when you're looking at the technical side, just look at how much is against you. It's just like insane. Like, again, the top prop firms, there's only 2 left, right? Like the industry has been almost completely dominated by the robots now, right? And then you compare that to the informational side, where like there are not as many people trading that informational side. Relatively speaking, there are so many index, like the market is dominated by index funds, right? All of these other sorts of things, institutional activity that is just very, very loosely associated with the technicals and the fundamentals and stuff, right? And so there are situations where you can really take advantage of it, and it's so much easier. It's so much easier of a game. You don't have to be the best. You just have to be better than most retail traders and more precise. Yeah. But yeah, the new market wizards are PhD quants. Exactly. That's exactly what it is. Yep. But I'm saying you don't have to be the market wizard or the PhD quant. You just have to know what's going on and be disciplined enough to only act when you know what's going on. Right? tell you what, I know a lot about automated trading and especially backtesting and stuff. But I feel very humbled by the amount that like the professional quants know. Okay, so here we're going to get the University of Michigan number. This is going to be a significant one for the markets. I can see the liquidity pulling here for the Treasury. You make sense, but how do we make sense? You gotta know what's going to happen. That's what I'm saying. I mean, there's multiple ways. Pick your poison. I'm just telling you what's the you know, like in terms of the amount of effort that you put in, what's the best risk reward in trading? It's trading informational inefficiency is what it is. In terms of a career, the amount that you have to learn compared to what you make. Okay, so we got a little move down. I see the 5-year inflation preliminary is 3% versus 2.9%. So that must be what's pushing the Treasury down here at the moment. The 1-year inflation is in line at 5.1 versus an expected 5.1. Let's see here. Conditions 57 versus 62. Expectations 52 versus 55, and sentiment 54 versus 59. So all of those, all of the consumer sentiment is lower than anticipated, which I would think is a net good for treasuries. Like we could move up, but I don't. But they did move down, and the only number I see there that really is out of line with that is the 5-year inflation preliminary. So I'm not too sure about that one, but I guess that means no trade for me off of this. Let's just kind of keep an eye on it, and maybe it will give a more clear. Maybe they turn to the upside a little bit more. So I do kind of feel, well, it did come back, but my reading of that is long. We should study the Fed. Yeah, totally. I mean, if you're going to trade the 10-year, then definitely. A lot of people on the floors were not trading their own. Well, yeah, they're placing orders from clients' banks, and that's another thing is that if people were going to pay me, so I think I would have to have a Series 7 license to do this, right? But if people were going to pay us to execute their trades, so they say, well, I want to buy treasuries, but I don't know if I'll be able to get as good of a price as you will get, right? I think that we've gotten pretty good at that game, don't you think? I think that I'm probably not as good as the guys at the block trading desk at Goldman Sachs, but I sure feel like I would love an opportunity to try trading on a desk like that and learning from them, you know? Oh, for sure. Well, so Slayer, one place where there has been a proven edge, although it is probably likely to be fleeting soon, was reading all of the actions taken by government representatives and officials, especially if you find a situation where a senator is buying a stock that is affected by a committee where they sit on that committee, or even better, they're like on the chairman of the board on that committee, right? It's like, they're overrated. They have the best block trading desk. Them and JP Morgan have the best block trading desks. When it comes to understanding their impact on the market and reducing that, they're the best at it. They really are. And in the FIC world in particular. And so there's a reason why they continue to smash it on the trading revenue. They know things. This year, Goldman calls were really bad. I'm trying to think, you're probably talking more about the Goldman investment research calls, right? No. So So you got to understand. So here's the first thing, okay? Is don't think of Goldman Sachs and JP Morgan and Citibank and especially those big banks, okay? Try not to think of them as a monolithic entity, okay? So a lot of the misperceptions around the bank companies stem from the fact that people don't understand that a bank holding company is really a conglomeration of 3 or 4 different entities, right? So Goldman has a asset management arm, that's GSAM. So there's GSAM, okay? And attached to GSAM, there is Goldman Investment Research, okay? So when you're on CNBC and you hear Jan Hatzius says that inflation is likely to continue cooling and that GDP is going to be X or whatever, right? They're talking about GIR, Goldman Investment Research, right? Understand, Goldman Investment Research, they're like not allowed to talk to anybody else at the firm. Like Jan talks to other people, but because he has to organize certain things, but they're not allowed to say anything about what their research that's coming out or any of that, right? They're simply not allowed to talk to other people, right? So there's the asset management arm of it, and then there's the GSCO side. So the GSCO side is the side that we more typically think of as like an investment bank, right? And on that side, there's 2 parts, right? One part is the investment banking part, of which Goldman is not the best. So in terms of like investment bankers, I think that JP Morgan still like really dominates that space, right? Okay. And that's the same with like, okay, if you're going to buy out Twitter, for instance, and they advise you on how to do that and everything, right? That's what those guys are doing, right? Okay. And then there is the side that basically is servicing hedge funds, right? So they are the prime broker side, essentially. Okay. So prime broker, they hold, you know, they do the market making, they have bids and asks, whatever, and they you know, that's where the account for the hedge fund has, right? Like your broker is AMP or Ninja Trader, right? And the hedge fund's broker is Goldman Sachs, right? Okay. And then attached to that, then they have the trading desks. And so there's some of these like market making kind of desks, especially in the fixed income side, because a lot of that is kind of more over the counter, right? And then there's the block trading desks, right? So if you wanted to, at least at what exists today, the trading that goes on at the bank that's most relevant to us, it's the block trading desk. Okay. And because they don't have a prop desk anymore, they spun off the prop desk, right? So what happens at the banks that's most relevant to what we do is the block trading, right? And that's where we learn all of this stuff about market microstructure and how to reduce your impact on the market and all of those sorts of things, right? And in that space, Goldman Sachs and JP Morgan are pretty close. And there's some metrics that suggest that JP Morgan is a little bit better at it. There's Morgan Stanley, who is, you don't want it because they leak your positions and front run it. But Goldman hasn't had that problem. Right. And so you learn how to execute. It's valuable stuff. And we can kind of, you know, what I'm doing is trying to take advantage of that stuff. What I know about how they execute that, right? To try and front run the block orders. Right. So then there comes to this other side, which is like, really what we're doing is more similar to like what the hedge funds do and stuff like that. So really there's probably a lot of stuff that we could learn from talking to people from the hedge funds, right? Or the CTAs. Antoine Krill is always preached a bottom-up fundamental approach to trading. After listening to Seth, I think it's informational edge. Yeah. So I actually don't agree with that though. Although I didn't learn this from Goldman, I'm trying to think about that. What they always would say. I mean, I certainly think that if you're going to be like swing trading, then you probably do want to take a bottom up approach, right? Like you want to go and find a company where there's something about that company that you really like, and then you learn everything about that company that you can, and to gain an informational edge on it to know when it's a good buy and whatnot, right? That's the bottom up approach. I actually favor a top down approach. So what do I mean by favoring a top down approach? So one of the largest forces in the markets is the macroeconomic factors. So if you can understand what the macroeconomic factors are and where they're likely to go in the near future, and then once you've determined that, you find specific plays, and then from there you're taking a bottom-up approach. From that point, you say, okay, it needs to be oil. So then which oil company do I get in? What's the proper oil company to get into to give me that exposure? And that's generally the approach that I like to use. But it here again kind of depends on what your goals and situation is as to whether you should be using a top-down or a bottom-up approach, right? Because the higher of a time frame, like the reason why I like a top-down approach is because a top-down approach is really good for what is the next 6 months to 5 years going to be, right? Whereas a bottom-up approach, which is much more like what you would do as like a Warren Buffett, for instance, he's looking super, super long time frame, right? Can we change the subject to something that is stop losses? Okay, so what do you want to hear about stop losses? Or you have a question about stop losses? Man, somebody, I hope they're doing okay. Because somebody in Discord took a pretty crazy trade and loss. There was some discussion about the dangers of stop losses on Twitter some time ago and how retail traders praise stop losses and don't understand what they actually do. And there's this graph that we could check. Oh, you gave me a link. Cool. I forget how this works. If I click this over here, it should open it up over here. Go to site. Okay. Oh, that's so I need to analyze this a little bit, but I think that they're bringing up a good point. That is true. Yes. This is true. So what they're saying is the retail trader thinks, okay, I have this distribution of all of my trades. If I put a stop loss on here, then what it's going to do is it's just got all of the trades that went further than this are now reduced. They're not as big of a loss, right? The reality is that if you A stop loss will change your win rate. Essentially, there are going to be trades that could possibly have been winners, maybe even if they were only small winners, that end up being losers because of the stop loss, because they went to the stop first, right? So it reduces your win rate. Okay. There's also this other side to it that I think is beyond that, which is this is looking at it from like individual trades, right? This is, there's another distribution, which is going to be like your daily, weekly, monthly returns, right? So if you have no stop, right, then you're probably going to run into where most days you win, right? So you're going to get something that's like skewed with a really fat tail, essentially, right? Yeah, Institute Trade made a video talking about the distribution of returns is basically capped. So the gist of this is, if I am backtesting a strategy, I'll come in and I'll backtest a strategy, and then I'll see, oh, okay, there was a couple of these losers that were really, really big. So I'm going to put a stop now so that those disappear, right? And you should just understand that putting that stop in there is going to reduce your win rate, right? And especially if you have a stop that's closer than your target, or significantly closer than your target, right? Then it makes it a lot more likely for you to get the loser, right? This is why so many retail traders basically start to come to the point of, oh, I just not have a stop, right? Well, if you just don't have a stop, what you're doing is you're taking on more risk, and you'll win more because of that, but you're also creating a far left tail, right? So the approach that I kind of take is that I have a stop that is like just protective, that's like really far away, and only you get hit in like a really terrible situation, right? And then I kind of have a mental stop where, I'm not willing to risk more than $5 or $10 on this trade, or whatever the deal is, right? Because the way that I take the trade, at least recently, has been, it should start going my direction, right? I should be seeing the volume coming in behind me, and if I don't, then it's not a good trade. So you don't have to really give it a whole lot of breathing room, right? I can give it like hardly any breathing room at all and still get 40 to 50% win rate, because there's an actual like edge, right? Yeah. I was always assuming a lot of risk, but it's true. You'll eventually get caught by being in the complete opposite side of the market and hurt a lot. Yeah. An easier way to express it is like, when you're looking at your back-tested NinjaTrader results, what is the longest losing streak? Because I can't tell you how many times I've tried to do a strategy. So I originally took the perspective of, okay, like let's make a strategy that takes on a lot of risk and gets away with it for the most part for a really long time. And every time that I do that and I go and I do the back test, there will be a losing streak in it that's just insane. It's like, oh, it works every time except for this one market where it blew the account, And it always ends up with a Sharpe ratio that's just absolutely terrible. But I tell you what, it's like the market tries to be statistically efficient, but it can't be statistically efficient against all strategies all the time. So it basically takes turns punishing certain strategies is what happens. Is what I think happens. And how do you know which strategy is going to get slammed next? I don't know. But that's kind of what I'm worried about here with the whole, like, I'm saying that the market is going to shift here, right? Is the kind of thing that I like, that I've been doing a lot lately, which is, I really get the market to run, and I can get trades that are as big as $200. That's not going to happen very often anymore. I'm going to have to go back to what I was doing at the very beginning with the micros, where I'm just making $10, right? Yeah, last Tuesday, right? The market began pushing higher and higher. True streamroller, if you were short, then what's your risk? That type of action was way out of the ordinary, and then the market completely, yeah. Right? And you'll go through periods where like the market is very trendy up, the market is very trendy down, where the market doesn't go anywhere at all, or where it's just crazy volatile, right? So what will happen is retail trader comes in and says, okay, I should have a 4-point stop on the S&P 500. Okay, cool. But then what happens when volatility doubles? Your win rate goes down. You're going to hit your stop a lot more often. Right? And what was like a really high probability trade all of a sudden turns into a 50-50 because the volatility of the market is larger than your stop and you didn't adjust it, right? The worst thing is you will close that losing position when you hurt the most, not the least. And when you hurt the most is around the price where the market turns around. Yeah, it's so true, right? You get out and then immediately it comes back. But then if you don't get out, they keep squeezing you. But I think that is kind of the thing, is like the market, the technicals do behave in a certain way in which it works against you, basically. It works against you. And you would think that, oh, okay, well, I should be able to use that to predict what it does, right? But the way that they make it work against you is they inject a ton of random volatility into it, right? And so the market kind of does these things because there's like certain incentives or ways to manage it, but there's just like not really a way around it. Because you could come back and you could say, okay, well, I'm down really big, but I need to hold on a little bit more because it's going to reverse, right? And if you do that, then you're going to get caught on the moves that go too far. And too many people doing that may actually make it more likely to continue on you, right? Versus y'all decide to get out, and that's exactly where it shifts. So it's like, right? You can't win that game because the only person that can win that game is the biggest guy, right? The market makers. The person that's able to take on the most amount of risk and so on and so forth. Right? That's why it's better to just be informed and to just avoid the fat telly events. And that's the other thing that I would tell you is like, in the back testing that I've done, you're going to find these periods where like the strategy doesn't work very well. And so you'll be like, oh, okay, so should I like take the opposite of my strategy in that situation or use a different strategy in that situation? And what I tend to find is that when you get into those regimes, it's better to just not do anything. If you catch the initial move and you're catching a really big trend like yesterday, right? Then push it as far as you can. But if you miss that initial move, you have to be more cautious. You have to be more selective because it's going to chop and you're more likely to get stopped out of positions, right? What drives this Nasdaq? He kind of shifted back to I have the biggest ego sort of a thing again. I've been wondering, so kind of I don't want to be offensive, but like, is that machoism kind of a thing in Arab culture? because I've been noticed that there's a lot of people that like, so like Andrew Tate. You know, Andrew Tate is Islamic, or he converted to Islam or whatever, something like that. That's why when they always talk about why is it that men can cheat but girls can't cheat, and it's like because a woman cheating is haram. That's why. That's his whole logic is really just that it's, you know, because of his religious belief, as far as I can see, right? And I've seen a couple of people that kind of have that kind of macho take, like Andrew Tate does, that they're kind of attracted to Islam. Market makers, well, I'm sure they probably are. In this kind of, I mean, why do you get the environment that you get? Because the market maker comes in and says it's not worth it, right? The volatility is too high, it's not worth it. So there's less liquidity. This is going to be really, so I tell you what, there's going to be a big change here in the treasury market, and I have no clue what it means for us. Because right now, when you're buying and selling treasuries, you're mostly interacting with the primary dealers, and they want to shift it to being a market more like the equities market, where you're more trading with everybody. It's all to all trading. And I don't know how that affects us over here. I suspect that it might mean that there will be more noise in treasuries than there is today, which would be kind of sad, to be honest with you. It'd be kind of sad, but you know, because I like that the treasuries only move when there's a reason for it to, you know. But man, it'd be cool if you made a vid about stop losses subject in this whole discussion. Yeah, well, so it's kind of an interesting take. So I do have videos on this though, right? So I have 2 videos on this, because I have one video is about performance metrics overall, and then I have another video about the backtesting of it, right? So that's the one where I draw the whole graph of your risk reward and say, okay, that's these kinds of strategies and that's these kinds of strategies, right? The conversation that you're talking about is a much more specific thing that I think would be better for shorts. I think like what I'm starting to find, paradoxically, is that TikTok the people that are watching shorts prefer really specific stuff. So if I come in and I say, hey guys, like, we're having a regime change, you probably might want to pay attention to it, you know, like that. I did that video last night. It did pretty well, but like all of the comments come in and are like, you know, not very valuable comments. Some of the comments were good, but a lot of them are just like, they want to argue with you or whatever. They don't think, no, the market's still going to go down, that sort of thing, right? But if I were to come in and say something like, you know, here's what happens with your distributions, right? I have to fit into a minute, but that tends to attract more attention if it actually speaks to the specific problem that people are experiencing. I don't know. I've been having trouble. So I made a video about my jigsaw setup. I need to record a little bit of an extra bit here, but I need to finish that today. That's my primary thing. I don't know. I'll probably do a practice test in the afternoon, I'm thinking. Maybe I'll do it this morning and I'll do the other part in the afternoon. I think I would rather do it that way. I thought here on the stream that we were going to do the PDF thing, but I think that we had enough to talk about that we didn't get to that. But that's okay. I'm almost done with the PDF. I might be able to put out like beta version of it so that you guys can like proofread and argue with it and stuff. So I was going through, I was like, oh, this is like better than some of these like small trading books that I've seen from other people that they sell for way more, like hundreds of dollars. And I'm planning on getting this away for free. That's because I want to make the real book. The textbook. Yeah. I'm still torn on whether I want to take a test first. Why was I avoiding the test? Okay, so the test takes 2 to 3 hours. So if I want to finish it before lunch, I need to start by 9. Which would be like right after this. But I can go into the noon. And then, but I also have been a little down because I didn't have my medicine for my ulcerative colitis. And I think I'm going to get that. I think I'll go do that first. And then, yeah. And do the thing in the afternoon. And then hopefully you can do another one. Maybe I can do 3 this weekend. 3 or 4 this weekend. I really want to get through with that, you know? I want to take the test. I'm not ready to take the test. I'm not ready to take the test, but I really want to take the test. Now, probably shouldn't do 3. I should work on the PDF and put the video out because I think it's a video that the channel needs going through the workspace. And after this, I do need to record an extra little part because I didn't include anything about tick compression. I think the way you solve this stop loss versus no stop loss problem is with right sizing like they discuss on it. But the problem is most retail traders don't have an account size to properly size trades. Well, okay, so like let's just say that you could trade up to 5 contracts. Like what? I'm not quite sure I understand what exactly they're saying about that, right? Like, the issue is if you're looking at that distribution, when you take the trade, how do you know which ones you should size up and which ones you should size down, right? But I think that what they might be saying is in situations when the volatility is higher and it's possible to get that bigger loss, what you need to do is you need to take not as many contracts. That's for sure, right? But ultimately, the kind of the thing is that any way that you come in and you manage your risk, it's going to affect that distribution. And a lot of the ways that we like to manage risks squishes that tail out, right? You think of it as like a piece of paper like this, you know? And if I come in and I try and push a bunch of samples over here into this profitable category, what it does is it squishes it down, and there's some of these other ones over here that end up being bigger losers because of it. Right? Yeah, that's why I think what they're saying is in higher volatility, you have to size your trades down, essentially. But you still have to have like a maximum acceptable loss, right? There has to be a point at which you say, well, this trade's not working, right? Or at the very least, I got a bad spot. See, I like to give myself enough risk that if I caught a bad stop, I can still kind of hang on. That's what I think is ideal. That means if we go back to a normal volatility range, I could maybe have a 15 to 20 tick stop. And right. And it's the same with like managing your risk from a day perspective too. You just realize that means that there's going to be more days where you take your maximum acceptable loss, because there's going to be some days where you hit that and then you kept trading and then you're going to make it back. And so well, okay, so the argument was also why stop losses? You just close the trade. Why also give your broker that information? Why drop that info into the market with that stop order? So if you are trading cryptocurrencies, then that might be a valid concern because they use that information against you. And we have plenty of evidence of exchanges themselves using the proprietary information that they have on their servers to trade against their own user base. Yeah, but here on the futures market, nah, they can't see your stops. They can't. They can't see your stop. The only reason why I think that it might be advantageous for you to not put a stop out there is there's going to be plenty of situations where it's going to touch your stop, go through, and then come back. So it's better to manage it manually if you can. Biggest problem for retail traders is overtrading. It's hard for me to say if it's the biggest problem, but I think it's certainly common, and it's certainly one of the most difficult things to overcome. And it was certainly the most difficult thing that I've had to overcome. And you notice this year trade way less. So what was the solution for Seth overtrading? Understanding when he actually has an edge. Once you move from trading technical analysis, even if it's technical analysis of order flow like I was doing, and move more towards making your primary focus on informational inefficiency, which is maybe like shouldn't be too much different, but from a psychological and philosophical perspective, it's like a really big change. And that change makes it so much easier to be selective with your trades. Because I don't know something. What's going to predict the flows today here? I don't have one. My prediction for the flows is treasuries aren't going to go anywhere because the banks are closed. Right? Seems like an easy solution to me, but it's the same thing, frankly, though, with like stops, to be honest, because think about it. When you're focused on technical analysis, really what it comes down to is like, what is the volatility of the instrument and how big of a stop do I have to give myself to make the statistical properties of this distribution that I've developed here work out the best, right? And there can be different ways of doing things. Like if, for instance, you're really trying to catch momentum, then like having something like a trailing stop can be really useful, but only when you're looking for like those really fast movers, right? Otherwise, I find it tends to not help. Anyways. Okay, but when your focus is on informational inefficiency, then the stop really has to do with my prediction is wrong. I'm expecting that people will come in at this time for this reason. I should see the flow. If I get in, I don't see the flow, I'm wrong, I get out. There's a study that found that trailing stops are worse than, generally speaking, they're going to be worse. Because it's what you got to realize, so any kind of like take profit or trailing stop sort of a thing just reduces your right tail, right? What it's doing is it's taking some of these samples that would be on the far right tail, and some of these samples that would maybe be like small winners or maybe even a small loser, and they're pushing more of them into that medium area, right? So you're taking stuff from over here and clumping it up over here. It actually ends up being in less profits, unless it's like a really momentum focused strategy. Something that I think would be appropriate for like an HFT. But what you're going to find in your study of this from a quantitative perspective overall is that stops and targets reduce your overall profit. Like this is just always the case. I've never had a situation where the stop and target didn't reduce the amount of money the strategy made. Usually the best is stop and reverse. Does that make sense? Let's have it. Well, but you get what I'm saying. Like, what am I really saying? What I'm really saying is that the real solution to this issue is don't be a noise trader, right? But no, I don't think I've ever. The stop and reverse. What I mean by stop and reverse is like you have a signal. You only get out of a trade when you get the opposite signal, basically. So it has to be something that signals frequently enough that, like, if you are against the action, it isn't too bad. But generally speaking, you can find stop and reverse performs the best. But here again, it's like, oh, it's just so funny. It's like the reality is that the way that we want to use these tools are not actually what they do to the statistical distribution, right? So you want to do a stop and reverse signal. That would make sense because you would take more trades and this sort of a thing. But why does that end up making you more money? Because you end up being in the market longer. So it's not actually mean that the stop and reverse ends up being a better signal to go long or short, right? It just keeps you in the market longer. The stop and reverse ones are definitely like those, especially is when you want to, like, if you're trading ES, you should compare that to like what was the overall performance of ES in that period, right? Because probably a lot of the edge that you're picking up on is just the directional edge of equities tend to buy. Well, Buffett has been right all along. I mean, that doesn't necessarily speak to what is appropriate for you and your goals, or like what is the thing to make the most money overall or anything. But the Warren Buffett approach to investing, which is that value companies tend to be undervalued by the market because they aren't the big popular movers, etc., is 100% true and has at this point a very strong array of backing evidence to it. That you get all of these stocks that end up doing really, really well over the long run, but the market never pays attention to them. And so they're just building value the whole time, and you can get outsized returns because of that. Here's my issue with the Warren Buffett approach to investing. There's no way that you're ever going to do it better than Berkshire Hathaway, so just buy Berkshire Hathaway shares. In my IRA, I don't have a ton in my IRA yet, but all of my money in my IRA is going into an index in Berkshire Hathaway. No, I take that back. I'm only putting stuff into the index in the IRA. The Berkshire in the main account. Berkshire is my second largest position. Because like what kept happening was like I got to a point where I was like, oh, okay, like some of these prices are reasonable. I might be able to pick up some of these companies. I think that an oil company might be nice, and maybe AT&T here. And then Berkshire kept buying all of the ones that I wanted. So I was like, why am I not just in Berkshire? So that's what I did. That's what I did. But I still got some other place, right? Like I still got my rare earth minerals. I'm kind of wondering if, well, I don't know. I think that if I'm going to put in more money to work, that I want to do it in January. I put a little bit more into my rare earth mineral stuff, although I kind of wonder if I shouldn't have diversified into different companies instead for that one. But I also think that I need to put more into tech, because yesterday, my overall portfolio was like 4.5% when the market performed 5%, because one stock was down. So that, you know, and I should have been up more than the S&P 500, but because my tech position has decreased so much, so I could put more in on that, but I guess I have to do a little bit more research on it. Stop and reverse sounds like the summer of George. So there's this guy on that he posts on futures.io a lot, and he's written a couple of books. What's his name? Kevin something such and such. Kevin something such and such. And he's basically trading technical analysis. So I think that there's some kind of flaws with like his general overall approach, but he has this one book where he basically goes through things and he kind of does the stuff is like, okay, what's the best stop strategy? What's the best target strategy? What's the best X, Y, Z, all of these sorts of things. And he goes through and he does those back tests. It's all 100% true. It's all, everything that he does. Like you might want to test, duplicate his code and test it. Well, it was written in TradeStation, so you'd have to rewrite it for NinjaTrader. But you know, rewrite it for NinjaTrader, perform them on your own instruments. You're gonna find that there might be some uniqueness to your own instrument, but they are real things. The thing is I don't think he asks the question, why is it that way? I think that there would be a lot. I think the thing is that you don't want to answer that question, because it kind of suggests to you that the market is random and time in the market is better than timing the market, and you know, but hey, there's a real information in there. And that's that's one of his biggest things is stop and reverse is actually the best strategy. Or have some sort of signal to go short. Don't do it based on how far it's moved, basically. How far it's moved is not a very good indication of whether it will continue against you or not, essentially. Is that a better way to put it? I don't know. Let's see if there's anything here on Twitter that we missed. Discovery Trading Group, the Treasury curve now in orange and prior softer CPI data in green. Interestingly enough, the biggest correction was in the mid curve rather than up front with the 5s and 10s. I'm sure mortgage markets will welcome any reprieve once priced, though. Give me your talking about forgiveness. Let's see here. Joseph Wang. Oh. How did the Federal Reserve get out of the yield curve control imposed during World War II? That would be something that we would that is pertinent to my interests. Then we get to Brannigan Barrett. Yeah, people did not really read it today. There's this thing from yesterday, Nick Timmerose. Goldman Sachs reports that its intraday estimate of U.S. financial conditions from its financial conditions index eased by over 50 basis points today, following the rally triggered by the October CPI print. That is the third largest single-day decline on record. I really think that we saw a pretty major inflection point, and that it is likely that many markets have seen their lows for the year, if not for several years. But I also think that the current move that the current bull run that we've got in the S&P 500 is very, very likely to get ahead of itself and pull back significantly, right? Very, very likely, don't you think? I think everybody feels that way, but every retail trader that's involved in the market probably feels that way, but what? You know, after we get this video and a video about Ninja Trader tips, I need to think a little bit more about what's the next major video to make. We should make more TikToks and stuff, though. What do you think of this? Let's see here. Oh, that's kind of interesting. Fundamental sophistication and technical sophistication. Well, so the big deviation that I would have from this kind of a thing is you have to realize it's not just about the fundamentals, right? But you could look at it from the perspective of informational efficiency or informational edge versus technical edge. And I think that this would still hold to a large extent. I think that Rentech is largely technical, right? they call the really big other way the fat finger. No, this is not the fat finger. This is no. This is wrong. Well, so this is just Sharpe ratio, positive Sharpe, and capacity. Is capacity like how big you can actually size up on it? Then that might be right. That might be true. HFTs and quant funds over here. Whereas Buffett doesn't have as high of a Sharpe ratio, but it's easier to get more out of it. The issue with, you got to realize there are some issues with the Sharpe ratio once you get to like professional strategies, right? Because there are a lot of professional strategies like in the HFT world that appear to have a really, really high Sharpe ratio. And that's just because there hasn't been a large enough event to see the tail, right? That's why you get all of these firms that like, they do super, super great. And then all of a sudden one day they just blow up. Yeah, your tweets are pretty good. Who was those words coming from? I tell you what, I still think that the best place to get information on the internet today is LinkedIn. So there's a lot of question about who where is this gonna go if like Twitter falls apart and stuff like that. Well, I think for us it moves to LinkedIn. Yeah, it moves to LinkedIn. I don't think Twitter's gonna go away though. I think that they're gonna have problems, but I don't think they're gonna go away. See, Nicholas Burgess this is this guy that he's got a book coming out about high frequency trading in the fixed income space. Correlation has been permanently suspended from Twitter for impersonating causation. That's flippin' hilarious. Yeah, you know, the issue that I find in the Twitter space for trading is like the stock market space is pretty well developed, if not too well developed, to the point that it's really hard to shift through all of the trash to find the good stuff. Options, yeah, there's people talk, but like when we're talking about like flows, predicting flows, nobody's talking about that stuff. Anybody, they keep it to themselves, right? LinkedIn, no, I don't think that. No, I think that they're their own company. Let's see here. Oh, they did get bought out by Microsoft in 2016. Really? Well, that's interesting. Yeah, I forgot about that. I don't think people realize, like, LinkedIn has kind of always been there quietly in the background, and they actually made some really significant technical contributions. There's a lot of technology that was originally developed for LinkedIn that ended up being used elsewhere in big data. Augustin LeBron has a nice book called The Laws of... Do I follow them? I think I do. Oh. No, maybe that's somebody else. August LeBron 3. The Laws of Trading. Well, I'll follow him because you recommended. Oh, no, wait. I am following him. I'm already following him. Make better decisions. Think like a trader. Yeah. Oh, and he's a quant. I followed him because of quant stuff, not because of... But what is his book about? Well, it's not the most expensive book. $20. Yeah. Might be worth taking a look at. I will add it to... Where is my list? I have a list. I have a special list. Add to list. That's a wish list. I don't know. The reason that I like LinkedIn is because you can get access to some of these like real professionals that... Like here. Alex Rover. Last week marked the end of my 26-year at JP Morgan. It has been a terrific trading journey. Tenure spanned 3 banks. I was like, so what are you doing? Oh, well, I'll follow him. Could be interesting. Could be interesting. haven't had much luck. There was like, you know, people that I would really like to get to connect with, and they haven't said. So you know what was funny was, remember we were saying there was that French reporter that reports at the ECB meetings that just sounded super smart, was good looking too. But and so I went and followed her, and she accepted the connection. It never shows me anything from her, but I thought that was pretty funny. But then there's some other, like, one of the problems that I'm having though is that I think that the people that I really want to connect with are like too old to really check their social media very often. You know what I mean? Wait, what the? Vincenzo C commented, every time I look into your big blue eyes, my world changes. That was on my little post that I made yesterday. That's funny, dude. There was somebody like made a comment on one of my TikToks too that was kind of like that. That was a little bit like, okay. All right, guys, it is time for us to stop. So next week should be interesting because we're not going to have as much news, and the flows might be a little bit more predictive again. So we'll see how we do next week. In the meantime, stay excellent.